Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. I'm cold. Now you might be thinking, dude, you live in Florida. How cold can it be? Well, it's kind of cold. It was in the 30s last night here in the Tampa Bay area. And yeah, I know it's a lot better than a lot of you have been dealing with because I was just among you. I was up in Kentucky. I had to go up for a funeral and I got caught in Snowmageddon. And I actually just got home yesterday evening. And I'm not going to lie, I'm really, really tired. So this podcast might be a little different. I usually script the shows pretty tightly, and I've not scripted this one tightly at all because, quite frankly, I'm tired. But I do want to try to put together a good show, and I do have some stuff that I want to talk about. So I think it'll be a good show, but it might be a little bit looser than what you guys are used to. I do want to thank you for listening to this show, as always. I really do appreciate it. I say this every single week, but I know that you guys have a lot of choices out there. There are a lot of people to listen to, a lot of things out there vying for your attention, and it means a lot that you spend a little bit of time with me every week. And I'm going to ask you, as I do every week, to do me a favor. If you would, go to wherever you listen to the show, to your podcasting platform, and write us a review. Give us those 5 stars, or at least 4. I think we're worth 4. Give us those thumbs up and share these episodes. We're trying to grow the show. We want more people to know about what we're doing here. And if you would share those episodes, it would really help us out. And I would say thank you. And plus, yesterday was my birthday, so you owe me a birthday present. So that can be my birthday present. You can go and share the episode of the show and write a review on your podcasting platform. I would say thank you. So anyway, I was up there in the midst of the big snowstorm. I was in northern Kentucky, basically in Cincinnati, and I think we got about 11 inches. It was interesting, though. I went up on Thursday, and of course, I'm paying really close attention to the weather because I know this storm is coming, and I'm trying to figure out, how am I going to navigate the funeral service? And my son lives up in northern Kentucky, so my hope was after the service, I could get to him before the snow hit, which that worked out. But, it got me thinking about weather forecasting. And this was a really complex storm, and they were having a really hard time locking in what the forecast was going to be. The snowfall totals went everywhere between 8 inches and 24 inches in the span of a few days. Like I said, I think we ended up getting about 11 in Covington. But it just goes to show how hard it is, even with all of the modern technology and the computer models and all of this stuff that we've got, it's still really hard to forecast weather in real time because there are so many factors that are influencing a particular storm. Will the track pivot just a little bit can make a big difference in a forecast. When warm air forces into cold air and all of these different things that they're trying to put together. And it's a little bit like trying to forecast markets and the economy. And I've talked about this before, I think pretty recently, the fact that doing economic analysis is hard because there are so many factors at play all together, right? So we can look at Federal Reserve monetary policy, and we know that loose monetary policy has certain effects. But how are those effects going to interplay with government policy, right? It can make a huge difference. For instance, you go back to 2006, 2007, when we were having all of this money creation, and a lot of that was incentivized into real estate because of government policy. So you have to figure out how all of these things are fitting together, and it's very, very difficult. And so it's easy to be wrong. Not an easy thing. So I felt kind of bad for the weather forecasters because I realized that their job's a little bit like what I'm trying to do here. And, overall, once they kind of got a beat on the track, they did a decent job, I think, of predicting. But anyway, on the subject of forecasting, in October, Bank of America raised its 2026 gold price forecast to $5,000 an ounce. Before that, I think it was in the $4,500 range. And mission accomplished, right? As of January 23rd, the price of gold was over $5,000 an ounce. In fact, this morning, gold is around $5,287 an ounce. And we also have $114 silver. I was telling a friend of mine the other day, a lot of the analysts that I really respect, that I listen to closely, were saying in the early stages of the silver bull market that once it broached $50, once it cracked that resistance, it would just take off. And that's exactly what's happened. So it kind of gave me faith in those folks in terms of their ability to analyze and see how things are going to move. But anyway, Bank of America has now upped its projection again. Of course, it has to because they've already hit their forecast. So now they're calling for $6,000 gold this year. And Bank of America analyst Michael Hartnett said that gold's performance in past bull markets influences thinking. So he's looking at, kind of the average price gain in these bull markets. And he said, quote, "History is no guide to the future." Fair enough. But the average gold price jumped in the past 4 bull markets was 300% in 43 months, which would imply gold reaching $6,000 by the spring. So he's just kind of looking at, past performance. And again, as we often hear in the world of investing, past performance does not guarantee future results, but it is kind of a benchmark, right? So we know that typically we've seen in these big surges 300% gains. Now, we could have more. Could have less, but it is kind of a baseline that we can start from. Earlier this month, Bank of America's head of metals research, Michael Widmer, indicated that he thought gold would become a key asset in investment portfolios this year. And I think that is going to be a very important dynamic moving forward. We've now got $5,000 gold. We're pushing towards $6,000. More and more people are getting interested in gold. They're looking at it and going, I probably ought to have some gold, right? So Widmer said gold continues to stand out as a hedge and alpha source, adding that gold will serve as a key hedge and potential return driver in 2026. And if you go back to a December note, Widmer said that bull markets don't end simply because prices reach high levels. I think that's a really key point because I know there are a lot of people out there that look at $100+ silver, $5,000 plus gold, and they think, well, it just can't go any higher. Well, yeah, it can, right? It's certainly possible. We have to look at the dynamics. It's not that, we get to a certain price and then boom, bull market ends, right? He said that the bulls will fade when the fundamentals driving the market shift. It's as simple as that. And at this point, we don't really have any reason to think that these dynamics are changing. In fact, it seems to be that a lot of these dynamics are intensifying, right? We're talking about de-dollarization, central bank gold buying, inflationary pressures, Federal Reserve monetary easing, geopolitical tensions, the U.S. debt and its fiscal malfeasance. None of that's going to end anytime soon. And these are the fundamentals that are upholding this gold bull market. Widmer said, quote, "I've highlighted before that the gold market has been very overbought, but it's actually still underinvested. There is still a lot of room for gold as a diversification tool in portfolios." Now, keep in mind, we're talking about a very mainstream analyst here, right? This is a guy that works for Bank of America, but he's a precious metals analyst, so he understands the dynamics of the gold market, and he understands these drivers that are under there. And he also understands a key fact that there aren't a lot of people who are really invested in gold right now. And as that shifts, as more and more people get interested in gold, as they diversify their portfolios with gold and also silver, well, that's just adding demand into a market that's already very hot. It's also important to note that tight supplies The tight supplies have been a key driver in the silver market, right? I've talked about that a lot on the show. There's just not enough metal. And the mainstream analysts seem to be focusing on the fact that, well, there's not enough metal in China, or we need to move metal from New York to London, and as if shuffling the chairs on the deck of the Titanic are going to fix things, right? It's just that there's not enough metal. Widmer said that he thinks supply constraints are also going to impact the gold market in the coming year. He forecasts that the 13 major North American gold miners will produce 19.2 million ounces this year, which would be a 2% decline from 2025. And he said he believes that most market forecasts for gold mine output are too optimistic. So we could start to see supply tightness in the gold market as we have in the silver. Now, it's probably not going to rise to the same level as we've seen in the silver market with this silver squeeze that's going on right now, simply because the gold market is so much bigger and deeper. However, if we do start having shortages of gold, that's only going to push the price higher, right? I really want to kind of focus in for a second on this idea that more people are getting interested in gold. I've talked about on the show how Morgan Stanley CIO Michael Wilson recently said investors should consider abandoning the traditional 60-40 equity bond portfolio allocation and adopt a 60-20-20 distribution with 20% of the portfolio allocated to precious metals. Now, this is really unprecedented, and it's really surprising to see this coming from the mainstream investment world, right? Because typically, mainstream financial advisors have been very anti-gold. Very rarely will you hear, your financial advisor guy out there on the street say, hey, yeah, you need to get into gold. Now, they might be saying that now. It's hard to ignore. But historically, they've not been interested in gold. They basically ignored it. And many have been antagonistic towards it and actually said, you should never invest in gold. I think about Dave Ramsey. He's one that's always, oh, no, don't get gold, right? Well, now we've got this guy from Morgan Stanley saying we need to have 20% of our portfolio allocated to gold. And Widmer said that the 60-20-20 allocation makes sense. He said, quote, when you run the analysis since 2020, you can actually justify that retail investors should have a gold share of well above 20%. You can even justify 30% at the moment. So how much gold does the average Western investor actually have? Less than 1% of their portfolios. Less than 1%. Now, imagine if all of these investors start to listen to Michael Wilson. And again, I've seen more and more buzz about the 60-20-20 portfolio in the mainstream media. If we go from even 1% to 2% allocation of gold into the average portfolio, that's a lot of gold. And if we actually got to 20, we're talking about a huge increase in gold demand. And again, people are really, really interested in gold and silver right now. It's in the news. You can't ignore it, right? It's hard to ignore something that's going up as fast as gold and silver are. And, going back to the storm, it kind of reminds me of weather preparation, right? As I was heading out of town after the funeral, I was driving from Lexington up to Covington. I stopped at the grocery store. I wanted to grab some snacks. I didn't want to show up at my son's house with no food. And as you can imagine, it was a madhouse. And they were out of bread and they were out of water, and everybody's shopping and they're getting ready. And this happens anytime that there's any prediction of a big weather situation. I'm very familiar with this phenomenon living in Florida. When there's the possibility of a hurricane, you can guarantee there's going to be no bottled water, there's going to be no bread, there's going to be no milk, as if your milk's going to be able to hold up if your electricity goes out. But everybody rushes out. And it just goes to show that human beings just aren't very good at preparing ahead of time, right? We tend to see the disaster coming and then we prepare, as opposed to, being ready ahead of time so you don't have to go rush out and get bottled water and milk as the storm is approaching. But that's just not how people do. But when they see everybody else rushing out, then they rush out. And I really think that that's kind of the dynamic that we're seeing in the gold and silver market right now. There's a lot of fear of missing out. I think there is some realization that this is a real storm, right? This is about something. It's not just the price of gold's getting higher, so I need to get some. I think a lot of people are intuitively understanding that this is signaling something, and I'm going to get to that here in just a minute. But we have all of these people that are running out, and they're grabbing gold and silver just in the same way that people in Kentucky were running out and grabbing bread for the snowstorm. And I think a lot of people might be listening to me now saying, man, I missed out. I wish I had gotten in on this ahead of time. Mike is right. I should have been prepared. It's okay. It's never too late. That's the good news. And yeah, it would have been nice, I'm sure, to get $12 silver many years ago, but you can still get silver. And again, there's no reason to think that just because the price has gone up a lot, it's just going to stop going up, right? We don't end bull markets just because the price gets higher. And if you are interested in getting into precious metals and you're thinking, man, I don't have any money right now. I don't have, $5,000 to buy an ounce of gold. I really don't even have, maybe I could buy an ounce of silver. Well, that's a start, right? And we do have a really cool program at Money Metals. You can do basically, it's a subscription or a monthly purchase plan where for as little as $100, you can begin building your metal portfolio a little bit at a time. And it's a really good way to just kind of quietly, put it on run and let it go. And over time, you will begin to see your precious metals portfolio build up. So that might be something you might want to check out over at moneymetals.com. So, yeah. So we have the price of gold touching $5,000, and it's getting increasingly more difficult to ignore it, right? Widmer said that this will likely incentivize more portfolio managers to consider both gold and silver. Duh. And he said this, just looking at benchmarks, gold has been one of the best performing assets for the past few years. No doubt, right? What we've heard a lot of the time is that gold is a non-yielding asset. It costs to hold it. You don't make any money from it. So what's the point of actually holding it? But just from a pure direction perspective, gold could have actually made a good contribution to a portfolio. I think the numbers speak for themselves. Couldn't have said it better myself. That's why I read his quote. But he's right. The numbers speak for themselves, right? And I almost feel like it's an understatement. Last week, I had the opportunity to interview Frank Holmes, who's a really good investment analyst. And in fact, Frank Holmes is one of the very first people I started kind of following when I was learning about gold and silver more than a decade ago. And so it's cool. It's cool being able to interview him. But, as we were chatting, it occurred to me just how wild this ride has been. I went back and looked. On January 30th, 2023, gold was still under $2,000 an ounce, right? It was like $1,900. This is 3 years ago. And at the time, there were some people that were talking about $5,000 gold, and they were all kind of way outside the mainstream, and everybody said, yeah, those people are nuts, right? Oh, they're worried about the dollar. The dollar's fine, that kind of stuff. The dollar's not fine, by the way. But yeah, $5,000 gold seemed like this fantasy fairy tale, and yet here we are. And, over the last few weeks, I've started hearing people talk about $10,000 gold, and still in my head, I'm like, wow, $10,000 gold, that just sounds kind of crazy, but is it, right? And, a lot of people are asking me, what's driving gold and silver higher? And of course, you can turn on any financial network and you'll hear the talking heads pondering this question. Is it central bank gold buying? Is it de-dollarization? What's causing this gold price to go up? Is it just demand? Is it a bubble? Now, we can talk about a lot of dynamics, right? And we have. I mentioned several of them earlier in the show. But maybe what is driving gold? Maybe that's not the right question. Maybe we should be asking why. Why is gold and silver blasting through the roof? What's this telling us? A couple of years ago, I started having chest palpitations, and it was quite concerning, as you can imagine. I have an artificial heart valve, and one of the indicators that it could be wearing out is heart palpitations. So I was kind of freaking out a bit. I was convinced that my heart valve was giving out and I was going to have open heart surgery soon. Turns out it was just anxiety and stress. My mom had passed away. We had done this big move. There was all of this stress in my life. So it goes to show how certain symptoms can have wildly different causes, right? My heart palpitations weren't telling me my heart valve was shot. They were telling me I needed to get a handle on the stress in my life. You've heard of people who have gone to the hospital convinced they're having a heart attack, and it turns out it's a panic attack, or, even acid reflux can cause those kinds of symptoms. So it's very important when you have a symptom, when you see something going on or you feel something, to figure out, what is this telling me? What does it mean, right? What's the underlying cause here? So what is this rapid increase in the price of gold and silver actually telling us? And a lot of people just assume that it means, well, gold and silver are getting more valuable. They're getting more expensive. More people want it. And yeah, that's part of the story. Demand is certainly driving the price higher. That's economics 101. But there is something else going on. And I think it's really important to sit back and get a grasp on what that really is. And in my mind, it's a pretty simple answer. Fiat currency, especially the dollar, is collapsing. The fiat system is teetering. It is built on a tower of debt. And that tower of debt is like a Jenga tower. And people have been pulling pieces out of it, and that thing is getting shaky. Gold and silver, real sound money, are reflecting concerns about this collapse. And again, when you talk about a dollar collapse, I've said this before. I don't think that we're going to wake up tomorrow and be Zimbabwe. We might wake up in 40 years and be Zimbabwe. That's more of a possibility. But, it's more of a death by a million paper cuts kind of thing. But it is significant. And it is important to understand that this is really what gold and silver are telling us. It's telling us about our money. I ran across a really interesting interview by Rick Rule. He's the head of Rule Investment Media, and another person, kind of like Frank Holmes, that I followed for quite a while. And he tends to have a pretty good grasp on the macroeconomic landscape. And he made a really interesting argument in this interview. He said that the bull market actually has been going on for quite a while, right? We tend to think that this bull market started 2 years ago. He says it actually started in 2000. And I think he hit the nail on the head when he gave his opinion as to why. He argues that the rising price of gold reflects a long-term erosion in purchasing power driven by negative real interest rates, thank you Federal Reserve and other central bankers, and ever-expanding government debt. So he's seeing this exact same thing, this devaluation of the dollar, which is a function of money printing. Okay, that's what the Fed is doing, right? Negative real interest rates, that's the impact of money printing. And of course, ever expanding government debt, which is something I talk about on this show a lot, and most people don't seem to care about. Rick Rule said, quote, "I would suggest to you that a gold bull market and conversely a bond bear market have been underway since the year 2000. And I think that this bond bear market is probably as important as the gold bull market because they're kind of two sides of the same coin, right? We see the struggles in the bond market reflected by persistently high yields despite the Federal Reserve's efforts to push interest rates lower. So this indicates a lack of demand for government debt. People don't want it. Remember that the price of a bond is inversely correlated with the interest rate, right? So as the bond gets less valuable, as that price drops, the yield rises conversely, and that's what we're seeing right now. So it's reflecting a drop in demand. This was overtly demonstrated by a Danish pension fund's decision to divest U.S. Treasuries. Now, many made the decision out as a political move, but the Akademiker pension, I said that totally wrong, but because I don't speak Dutch. But anyway, the pension fund spokesperson said that this wasn't the case and instead cited concerns about the U.S. government's fiscal malfeasance. The spokesperson said the decision is rooted in the poor U.S. government finances. end quote. And he went on and he said that the driving concern is ever-increasing U.S. debt and decades of overspending, and that the U.S.'s finances, quote, made us think that we need to make an effort to find an alternative way of conducting our liquidity and risk management. This, ladies and gentlemen, is how de-dollarization works, right? And, a lot of people are like, oh, this is all about Greenland. It's all political. And the spokesperson even addressed that. He said, yeah, it made it easier to make this decision, but that wasn't what drove it, right? It's not just about politics. And, even if it is just about politics, what difference does that really make? It doesn't change what's going on. And, I think sometimes that Americans, we can get this attitude of, well, we're going to do this and who cares what people think about it, right? We don't care about the Danish. In fact, the Treasury Secretary actually said, well, this doesn't matter. We don't care what the Danish people do. They don't have that many treasuries anyway. It doesn't matter. But yeah, it does matter, right? You have to consider blowback from policy decisions. And it doesn't necessarily mean you don't do the policy, but you at least have to take into consideration what could happen as a result of this. And I don't think the U.S. is very good at that. I think the United States tends to have this kind of arrogance about it, that we're going to do this and the world will accept it. Well, the world doesn't have to accept it, and they're not accepting it. We are seeing this de-dollarization. It's a real thing, right? We also got news this week that, once again, there is a lot of talk in Germany about pulling all of the German gold out of New York. And again, you can say, who cares where the Germans hold their gold? And I get that. But again, it tells you the mindset of people outside of the United States. And they are wary of what the U.S. is doing. They're wary of our foreign policy. They're wary of our fiscal performance. They are trying not to expose themselves to things they think could be harmful. And that is a big problem for the United States. And I've gone over this over and over again about how problematic this de-dollarization is. But, you can't really argue with the folks that are saying that they're worried about U.S. Fiscal irresponsibility, because all you got to do is look at the numbers, right? Last October, the national debt eclipsed $38 trillion. And despite record tariff revenue, the federal government continues to run large budget deficits month after month after month. Spending is going up, right? We had DOGE and all of this talk about spending cuts. There's been no spending cuts. There have been spending cuts, but they've been offset by spending increases. We're spending more money now than we were last year. And, Rule pointed out it's not just the national debt. He said the net present value of unfunded entitlement liabilities exceeds $120 trillion. So we're talking about Medicare, Medicaid, Social Security, federal pensions, those things that politicians are very, very reluctant to reform because so many people depend on them. And Rule went on and he said combining these unfunded liabilities with a $38 trillion federal debt leaves little margin relative to aggregate private net growth. In other words, all of this government spending is squeezing out the private sector and the private economy. So what's the solution? Well, Rule said the only option is for the government to lean on the inflation tax, and that's exactly what it's doing. Remember, I did a whole show probably about a year ago about how inflation is a tax. It is a way the government can, by inflating its currency, kind of inflate away those debts. Rule said, quote, my suspicion is that the way we pretend to honor our obligations is that over 10 years, we inflate away the net present value of the liability. So Rule said that too many investors get caught up in the price instead of considering the value. So what he's saying is we get caught up in, $5,000 gold. And we look at that price. But what we really should be looking at is what can gold actually buy, right? How much is healthcare or housing or everyday goods in terms of gold? Make gold the unit instead of dollars, right? He said, quote, if you thought about them in gold terms, you'll decide that they're very cheap. Which is kind of crazy, but it's true. So many of these things that are so much more expensive today, it's not that they're more expensive, it's the fact that the dollar buys less. It is a devaluation of your money. And Rule made a really interesting point, and I've been thinking about this. I think he might be onto something. He characterized the recent surge in gold as a catch-up, noting that gold had failed to reflect the steady deterioration of fiat currencies for many years, right? It got papered over. Remember how I was talking about how it's difficult to forecast the weather because there's so many factors? Well, there's so much stuff going on in the economy that people lost track of the fact that we're constantly devaluing the dollar. And the world is waking up to that reality, and we're seeing the price of gold catch up and begin to reflect that devaluation of the dollar. But again, it's not really about what gold's doing, it's about what the dollar's doing and other fiat currencies as well. Rule compared the current environment with the 1970s, noting that gold tends to rise in nominal terms as currency erodes. That's basic economics right there, right? So I'm really emphasizing this interview with Rick Rule because I think he did a really good job of succinctly summing up what I've been trying to put together over the last several months myself. So I like it when my thinking dovetails with somebody else's. And again, I think he did a really good job. I think he hit the nails on the head all the way through, right? And he's built a pretty sound theory with his analysis. So looking ahead, Rule said that negative real interest rates, ongoing erosion in purchasing power, and years of underinvestment that now required renewed capital spending will continue to support gold, and that the dynamics driving precious metals higher reflect structural conditions, not a temporary trade. And I think he's absolutely right. We are seeing a significant shift right now. We are in the early stages of what I think is going to be a seismic shift in the world's monetary system, where the dollar is going to have less of a role. I'm not saying that it's not going to have any role at all, but I think the role of the dollar is going to be less. We're already seeing it being less, right? Other currencies are beginning to be used in trade for oil. Countries are looking for ways to basically do business without using dollars. We're seeing this difficulty in the bond market. We're seeing treasury sell-offs. All of this is happening, and it's reflecting this shift. And it is bad news for the United States because, as I've said over and over, the U.S. government depends on demand for dollars. It needs the world to need dollars because as the U.S. prints money to finance its huge government, to finance all of this borrowing and spending, all of this money printing has to be absorbed somewhere. And the U.S. has been blessed to be the issuer of the world reserve currency. And so the world has gobbled up these dollars. It needs dollars to transact business. But when the world doesn't need as many dollars, where do they go? Well, they're going to come home. That means inflation for us. So I believe that we're heading into a world of persistently high inflation. In fact, we've been in a world of persistently high inflation for a long time when you define inflation properly, right? As the increase in the money supply. We've been jacking that money supply. Go look at an M2 money supply chart. You can look it up on Google. And the Fed keeps a really nice chart. It's gone seismic since 2008. That's inflation. We're in this environment and it's not going to change. That's why you want to have real money. You want to have gold and silver. And I know right now you're probably hearing, especially with silver, that a lot of dealers are out of inventory. And I am excited to tell you that here at Money Metals, as of this point, we still have plenty of inventory. We have both gold and silver. And if you want to get some, you can definitely order from us. You're going to get it. Now, there have been some shipping delays. It is harder to get stuff out. Money Metals has hired over 50 people since Christmas just to keep up with the surge in business. So, if you have some delays on the phone, if shipping's a little slower than normal, you can expect that. But we do have the inventory. So if you want to get gold, if you want to get silver, do not hesitate. And, if you have questions, you're welcome to give us a call, 800-800-1865. You can talk to a precious metals specialist. Again, there could be some delays on the phone. I would recommend recommend not calling unless you have specific questions. But if you do have questions, please don't hesitate to call, because our folks, they love to answer the questions and they're very good at it. They will help you figure out how gold can fit into your portfolio. They'll help you figure out what mix of metals might work for you, what products might work for you. So don't hesitate to call if you have those questions. But if you know what you want, don't make the phone call. Just go to moneymetals.com. You can order online, and we'll get it packaged up and shipped out to you. Or, of course, you always have the option of storing your metal in our state-of-the-art bullion facility in beautiful Eagle, Idaho. One of the most amazing security systems I've ever seen is in that bullion depository. It was really cool being able to go out there and visit it. So you can store your precious metals with confidence in our bullion depository. But, as I said, it's time to act now, right? You can't generally buy your house insurance when your house is on fire. Fortunately, we don't have that rule with gold and silver. You can still get it, right? You're going to pay a little bit more than you would have a few months ago, but I think there's still plenty of upside. And, again, you have to look at it not from, gold is going up. You have to look at it from my purchasing power is going down. The government is destroying my money. Therefore, I want to save in real money. I don't want to hold on to dollars that are going to buy less in 10 years. I want to hold on to gold and silver that are still going to buy the same mix of products that they will buy today. So, I think that's an end of this show, and hopefully it has not been as disjointed as it has felt in my head. Generally speaking, I run through these pretty quickly in terms of not having to stop and start. I've had to stop and start like 500 times today because I'm not going to lie. It was a very stressful week being on the road. Florida man does not like the snow, and so I was a nervous wreck driving in it. But all is well. We're safe and sound. We got a good show in. I hope you did enjoy it. So we're going to call that a wrap for this episode of the Midweek Memo. You can get more information about everything that I've talked about on the show today and a whole lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you join the other million-plus people that are on our email list. Of course, you can subscribe to the Midweek Memo podcast on your favorite platform. And when you do, you'll also be able to tune into our Market Wrap podcast every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and other interesting people from the world of gold, silver, economics, and investing. Again, thank you so much for listening to the show. I appreciate it. Remember, you owe me a birthday present to go post this episode on social media and give us that review. So thank you again so much. Hope you have a fantastic rest of your week, and I will be back again next Wednesday.